Good evening, everybody, and welcome to my first-time homebuyer seminar. I'm glad that you all could make it here today. So I'm going to go ahead and get started. First of all, I want to make sure that everybody has the opportunity who's on the Zoom meeting to open up the chat window. If you have questions about anything that I'm talking about over the next hour, please feel free to post it into chat. I'll either address it immediately or I will address it as I get closer to that part of the presentation. So I'm going to go ahead and get started, here we go. All right, so first of all, we're going to talk about the process of buying a home, and that process has really changed a lot over the last month and a half. I think we all are dealing with a lot of change in our lives, and so I'm going to address a lot of basic things about the home buying process, but I'm going to talk a lot about the specifics that are impacting the market today, and how home buying has changed and what I think is going to happen over the next 3, 6, 9, and 12 months. So here we go. First of all, I want to start with introducing myself. So my name is John King. I have been a mortgage banker for 19 years. I worked for a large mortgage bank for about the first 10 years of that time. And now I have been with Summit Funding for, I believe it's been just about 9 years. So I absolutely love what I do. I have been married for 21 years at the end of this month. We get to celebrate our wedding anniversary in quarantine, and have 3 beautiful children, a 8-year-old girl, an 11-year-old boy, and a 12-year-old girl. So I absolutely love what I do, and I'm passionate about helping people and educating people, and that's a large part of what I'm trying to do for you guys here today. So I do want to share with you who Summit Funding is and what makes Summit Funding different. So as you look at buying a home, you're going to see basically 3 different types of mortgage companies that are out there. You're going to have big depository banks, you're going to have brokers, and you're going to have what's called a mortgage bank. And a mortgage bank is kind of the baby bear of the 3 little bears, and that is what Summit Funding is. We source our money directly from the federal government through Fannie Mae, Freddie Mac, FHA, and VA. We go direct and we cut out the middleman. The small brokers, they have to send their loans to the big banks, and the big banks, honestly, are very picky and choosy about what they're willing to take as risk. And they are, especially in today's environment, they're taxed with a lot of challenges that are coming along with the economy, and they're scaling back a lot of their lending. And so Summit Funding is perfectly suited to really give you the perfect mortgage and be able to give you the best mortgage experience, because that's all we do. So what makes us different is communication, first of all. It's part of what I'm doing here today and communicating this with you and showing you everything that you need to know so that you can have a great experience and that you really understand what you're getting yourself into. Our second key is we think we deliver the finest client care in the lending industry. You'll hear in a couple of minutes why I'm going to tell you that's a really, really low bar. Like, our industry stinks when it comes to taking care of people and delivering great client care. So to say we're the best out of an industry that stinks isn't really that great, but we try hard to really make sure that we are delivering on that promise and taking great care of you through the process. And then the third thing that makes us different is timely closings. Especially in today's world, the banks are inundated. Everybody is trying to refinance their home because interest rates have dropped significantly, and it's causing a huge drain on resources where these banks don't have the time or the manpower to get your loan closed in the time that it was scheduled on the contract. And that's a problem for you and for the seller, because y'all have moving trucks set up, you've got to schedule utilities, you basically have a plan around that closing date, and especially in today's environment, it's important to work with a bank that is focused on closing on time. Now, one of the things most people are asking is now a good time to buy my first home? And I'm going to address that very directly and say, if you're in it for the long run, every time and any time is a great time to buy your first home. So that's my general statement. If you're in it for the short run and you're saying, hey, I'm going to buy a house and I'm going to sell it in a year, I'd be concerned, because you have costs for buying the home and then you have costs for selling the home. So even if the house price went up a little bit, you're not going to recoup what those costs were for buying and what those costs were for selling. And we don't know where the market's going to end up in the short term. We're definitely having some challenges right now with inventory and with ability to show homes simply because of the shelter in place. So that's creating an environment that has some questions about where values are going in the short term. But in the long term, if you think about the last major housing crisis that happened in 2008, housing prices fell from 2008 to 2011. So it was a 3-year fall. Then they turned around and started going back up. And by the time we hit 2018 or 2019, the housing prices were back up to where they were back in 2008. And think about what rents have done since then. Think about it. If you had the opportunity to go back in time right now and buy a home in 2008, would you do it? Now, a lot of people are going to say, no, John, that's a horrible idea because housing prices dropped. But if you planned on staying in that house and you stayed in that house the entire 12 years from 2008 until today, you would have A, paid down a significant amount of your mortgage and built a large amount of equity in the property. B, think about what rents did over the last 12 years. Rents skyrocketed, but if you had bought a home in 2008 and got a fixed rate mortgage with a fixed monthly payment, you wouldn't have to worry about those rents going up. You would have had a stable monthly payment the entire time. And then C, you would have had a huge tax write-off because owning a home is a great tax break, and you would not have had that if you were a renter. So if I could go back and buy my primary home again in 2008 versus deciding not to buy a primary home in 2008, hands down, I would buy it, even knowing that housing prices drop significantly over the next 3 years. I don't think we're going to have anywhere near that type of a drop in the next cycle. I don't think we're in that cycle right now, and I actually think prices are going to rebound once home buyers are able to actually go out and start buying again. And so right now, literally right now, represents an amazing opportunity for you to go out and purchase a home and not be competing with everybody else on the market. So buyers are scared, sellers are scared, people don't want to go out and look at homes. You shouldn't be, but you can do it virtually. You can have the agent preview a home for you. There's ways to buy a home right now, and the opportunities are amazing that you can get because you don't have a lot of competition. Once everybody gets released from the quarantine, now you're going to have the floodgates opened up because everybody's going to get tired of the house they've been quarantined in. And they're going to want to go buy something bigger, and that's who you're going to be competing with. So if you can make it work right now, now is a much better time to buy than even a couple of months from now. There's a couple of reasons why it might not be a great time to buy, and I'll cover some of that now. Getting a mortgage today is tougher than it's ever been. And I've been doing this for 19 years. It is tougher than it's ever been to get a mortgage today. We've got significant regulations. We've got government regulation. We've got state regulations. We've got an economy in flux. We've got some pretty significant job losses. And in the last month, we've had some very significant guideline changes on what types of loans that we can do and under what circumstances that we can do them. I'm not going to cover all of those changes, but I'll tell you that the mortgage world is certainly tightening up. Some of the things that are starting to go away, if not completely gone away, are down payment assistance loans are almost impossible to get right now. We hope down payment assistance loans are going to come back and be available down the road. But right now, you need to have your own money for a down payment because the market is tightening up. The mortgage world is concerned about the flow of money, and they're concerned about people losing their jobs and not making their monthly payments. And that is creating a tighter mortgage market. But if you can qualify in that tighter market, it's also created huge opportunity for all-time low interest rates. We've got rates right now, guys. 30-year fixed FHA rate today was under 3% interest rate. Absolutely crazy good interest rates to lock in an under 3% interest rate if you're a first-time home buyer. You don't have to be a first-time home buyer to buy FHA, but it's the most common program we use for first-time home buyers, and it only requires 3.5% down payment. So if you had that money for that down payment, you could lock in a 2.99% interest rate today. That gives you a cheaper monthly payment than if the housing price dropped by $20,000, but the rate was 4.5%. The people who are paying cash for homes, it's better off for them to wait and see if the housing prices drop. But if you're borrowing the money to buy a home, you are much better off buying when rates are low, not when prices are low, because a majority of your monthly payment goes towards interest, which means the lower your interest rate, the lower your monthly payments. I want to encourage you guys, by the way, to post questions in the chat. If you have questions about anything I'm talking about, feel free to post it. If you have a question that I'm going to be getting to, I might ignore it, and I'll get to it down the road. But I do want to make this as interactive as I can in helping answer the questions that you guys have. All right. So I talked to you about the fact that we think we deliver the finest client care in the mortgage in the industry. Well, here's the deal. If you look up here on the top of this slide, a Fannie Mae survey reported that 68% of borrowers were dissatisfied with their home loan experience. We're just a highly regulated industry that does not do a good job of taking care of people. We don't do a good job of answering questions. We don't do a good job of communicating well. And that's something that I'm committed to be different, because I'm not focused just on giving you a great product. I'm focused on making it an amazing process, because I want to turn each and every one of you into raving fans that tells all of your friends, family, neighbors all about me. So that's really my focus. And I'm committed to giving you a great experience by giving you the right product and the best client care possible. Here's the problem with the mortgage process. Getting a mortgage is really like flying in an airplane. And I'm confident all of you have flown in airplanes before, and I'm confident that you have run into turbulence while flying in an airplane. And if you think about it, was it the pilot's fault that you ran into turbulence? No. It's not a sign of a bad pilot when you run into turbulence. It's a sign of a bad pilot if you run into turbulence and he didn't first put on the fasten seatbelt sign. Or worse yet, they just served you hot coffee and then you run into turbulence and you spill it all over yourself. That's a sign of a bad pilot. But a pilot that warns you you're running into turbulence, that's the pilot's job. The pilot's job is to get you from your starting point to your destination on time and safely. And that's my job too. If the pilot can fly around the turbulence, he's going to. If he can fly above it or fly around it, he's going to do that. But sometimes the only way to get to the destination without running out of gas and crashing is to fly right through the turbulence. The mortgage industry is the same. Buying a house, you will have turbulence. You'll run into problems. Some of them we're going to see ahead of time. Some of them we're not. And so just be prepared for the fact that as you're buying a home and as you're going through this process, a great experience is not one that's without turbulence. It's one where we're sitting there by your side, holding your hand and making sure that we get through it together. So that's really my job as the pilot, and my team will do the same thing in the cabin and taking great care of you through that process. So let's take a couple minutes and talk about the process. The first thing you have to do is get pre-approved. You're going to see the word pre-qualify. You're going to see the word pre-approve. They're used interchangeably. The truth is, the real estate agent that you work with needs you to have a full approval that says that I have reviewed your income, I've reviewed your assets, I've reviewed your credit, and that you meet all of the criteria necessary for a mortgage. That has to be done up front, because a seller is not going to look at your offer if you don't have a pre-approval letter in hand. There is a big difference between having a pre-approval letter from a local lender that's known versus having a pre-approval letter from a large bank that has a call center in Topeka, Kansas. Because I have my reputation at stake. When I tell a realtor you are qualified, that realtor knows that if I'm wrong, he's never going to accept one of my offers again. And that is one of the biggest things that I bring to the table, is I have skin in the game. Because if I say somebody's approved and I continue to fail, then my reputation is mud in the industry. And that works in your favor, because the realtor knows that a local lender who's issuing an approval letter doesn't want to tarnish their name by issuing a letter that isn't fully validated. That won't get you a house for $20,000 less than somebody else, but it will get you a house when you're competing and you both wrote an offer at the exact same price, and the only difference is a local lender versus an online lender. That can make a huge difference between your offer being accepted versus somebody else's offer being accepted. So step 2, once you're pre-approved, is to go find your home. I'm going to talk to you a little bit about your real estate agent and what their role is. First of all, your realtor works for you, but they're paid by the seller. So you are not writing a check to a realtor, but they are getting paid for the transaction and for taking care of you. They don't get paid for putting you in the car and driving you around. They don't get paid for anything other than closing the transaction. But that's their job, to guide you through the process. And there's a couple of warnings I want to give to you as you're going out in the process of buying a home and specifically working with a realtor. The most important warning is pick one realtor and stick with that realtor unless or until it's not a good fit. It does not help you to work with multiple realtors at the same time. I've had many, many clients who have told me, John, if having one realtor look for me is a good idea, then I'll have 2 or 3 look for me, because then I'll have 3 times as many eyes out there, and now I'm bound to find the right home. And that's just plain not true. Your realtor has access to all of the same information and all of the same listings through the MLS system. The difference is, if you're working with 3 different realtors, the first realtor shows you a house and you're like, oh my God, that house is perfect. Oh, but man, the backyard's too small. And the second realtor shows you a house and you say, oh my gosh, that house is perfect, but the kitchen is too small. Well, guess what? Neither one of them know that you didn't like something that the other realtor had shown you. So now you're going to have the third realtor show you a house that doesn't have a big enough garage. And each of them only has a little piece of the puzzle. Each of them is only aware of a portion of what your likes and dislikes are. It's going to take longer to find a home when you work with multiple realtors, not shorter. That's the biggest key, is pick an agent and stick with that agent. Here's another warning about working with real estate agents. Do not go to a home with any other realtor except your realtor, with the exception of open houses. Now, first of all, right now, open houses are extinct because of the shelter in place. You don't have realtors hosting open houses. But when they do, that's okay to walk into an open house, because it is an accepted practice that the realtor hosting the open house only represents the seller. And if you say that you're working with an agent, then they're not representing you. But here's something most people don't understand. There is a rule in the real estate world that has to do with a term called procuring cause. Who was the realtor that procured you as a buyer, and they were the cause of you buying this home? So this comes into play on a Sunday morning, back, in the days when we're not quarantined, and on a Sunday morning, and you see the perfect home just popped up online, and you say, oh my gosh, I want to see that house. But I don't want to bug my realtor on a Sunday morning, so I'm going to call the guy whose name is on the sign and have him open the house for me, because clearly he's getting paid, so he'll be happy to do it. Guess what? If that person lets you into the home, they are the procuring cause to you buying that home. They have the right to represent you, not your realtor. You just lost your representation by accident. Now, some realtors will let you out of it and say, no problem, go work with your realtor. Other realtors won't. Do you want to take that chance? So it's super, 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 super important to call your realtor and say, hey, I'd like to see this home. It's also super important to respect your realtor. If it's a Sunday and they take Sundays off, I'd like to see this home tomorrow when you're back to work. Okay, but the key is, do not go to a home with someone who is not your realtor unless your realtor has prearranged that to happen. As you're out house shopping, guys, you may get your first offer accepted. You may write many, many offers before you get an offer accepted. And so just be aware it's a process. And the hardest question I get asked by buyers is, John, tell me about the market, because my realtor is telling me I should be offering $10,000 more than what this house is listed for, and I think they're crazy. Well, the first thing is, do you trust your realtor? Because your realtor's job is to guide you. The second thing is that the crazy person is not the realtor, the crazy person's the seller, because the seller is setting the price of the home, and rarely is the seller using the same strategy as other sellers. And I'll give you some examples. You might have a seller who is extremely invested in their home, and they're emotionally connected to that home, and they say, oh my gosh, I painted every surface inside this house. The pink, purple, and yellow walls were my handiwork, and it makes the house worth more than any other house in the neighborhood. And they're emotionally vested in the price. And they're going to price that home higher than what that home really is going to sell for on the market. You might have another seller who says, you know what? I want to get as many offers as I can to create a bidding effect. So therefore, I'm going to take the house. I know another house just like it sold for $350,000. So I'm going to list this house for $299 because everybody's going to want it. And then I'll make them all compete against each other. And I'm thinking I'm going to get them up over 350. And I'll get a better deal because you end up spending more money in an auction than you would if you just saw the price and said, I wanted to buy it. They're going to buy, or they're going to get caught up in the bidding. And so you have the exact same house that should sell for 350 that the emotional seller lists for 375, but the savvy seller that wants to create an auction effect lists it for 299. Which one's the right price? The answer is neither one. And that's where your trusted realtor comes into play, because they're going to guide you into knowing how much to write that offer for. And they're going to say, hey, I know this house is listed for $299, but the comps say it should sell for $350. At the very least, I think you should offer something closer to $340. And they're also going to say in the same circumstance, hey, I know this house is listed for $375, but I think we can get it for $350 because the comps just don't support it, and it's been on the market for quite some time with no activity. So I think we can underbid on this one. And you have to trust your realtor, because there's going to be three different situations. So you have that person that sold it for the right price. And so the price is not what the seller lists it for. The price is what the highest price a buyer's willing to pay, meeting the lowest price the seller's willing to let it go. That's the definition of market price. And once you are that person, you get your contract accepted and you go on to step 3. Step 3 is we process your loan, and we basically often do step 1 all over again. I'm going to get all your paperwork again. I'm going to get your income, your assets. I'm going to repull your credit, and I'm going to double check everything because we have to have current documentation. Okay. Then we're going to send all of that documentation to step 4, which is the underwriter. They're the final decision maker that has the authority to approve your loan on behalf of whoever the ultimate entity is, whether that be FHA or VA or Fannie Mae or Freddie Mac. Okay, so that's where the underwriter's job is. And then it's the fun part. You get to sign your documents. Right now, document signings all still have to be done in person. I know we're in a shelter in place, but unfortunately, it is the law that notarizations have to be done in person. There are some changes to that law. The technology exists to do something called remote online notarization, but that technology hasn't been adopted in most states, and California is one that hasn't adopted it. And so notarizations still have to be done in person, even in a shelter in place. And then finally, step 6, the best part, you get to buy pizza and beer and have all your friends come over. Oh wait, social distancing. You get to pay a mover to bring you over and put you into your new house, and you get to move into your new home. So it is an amazing opportunity to get the keys to your home. It's my favorite part of the job, and that really is the process. I do want to add something that is a major concern in today's world, and that is continuity of income. We've got a lot of changes happening with job losses, with the economy, and people, because of the COVID shutdown, are getting laid off or furloughed or reduction in pay. And so just because at step 1 you got pre-qualified and you had enough income, even at step 3 or 4 when you're in processing or underwriting and you had enough income, we're verifying up until the day we wire the funds. And if anything has changed about your income until that, up to that day, we're going to verify that, and it may unwind things, or at least cause us to go back to step 4 to verify you still qualify with that lower income. So that's a pretty significant concern that we're dealing with right now in buying a home in 2020. All right, again, feel free to post any questions in the chat. I'm sure I'm doing a perfect job in answering all of your questions, but I hope that there's at least one question, because otherwise I think you're all sleeping and you haven't paying attention. All right, so now I want to talk about types of loans. Before I dive too deep into types of loans, I want to cover really the 3 things on the left side of this screen: cash, credit, and income. Those are actually the only 3 things that we care about, with the exception of property. Okay, so there's really 4 categories I care about when as a mortgage company, to approve you and your loan. Cash, how much money you have for down payment, closing costs, and sometimes we care about reserves. Credit, how well you paid your bills in the past. because how well you've paid your bills in the past is the best indicator for how well you're going to pay your bills in the future. And then income, because no matter how good your credit is, if you don't have enough dollars coming in the door to make the payments, it's impossible to make all of your monthly payments on time. So cash, credit, and income are the three things that we care about. Property stands alone. Property says the house is in good condition with no health or safety hazards, and that it is worth what you're paying for it. So the appraiser goes out. It's not a home inspection. The appraiser isn't testing everything in the house. The appraiser isn't testing everything in the house. The appraiser is not doing a full home inspection. You can pay for a home inspection if you want, but hold on one second here. Okay, so you can pay for an inspection if you want, but the appraiser's job is to go into the home as my eyes and ears, verify there are no health or safety hazards, and to make sure that the property is worth what you're paying for it. Now, I said a couple minutes ago, the definition of market value is the highest price that a buyer is willing to pay, meeting the lowest price the seller is willing to accept. And we've already defined that market value because you have a contract. You're that highest paying buyer, and they're the lowest priced seller for that same type of a home. But the appraiser has to make sure you're not the only one crazy enough to spend that kind of money to purchase the home. And so what the appraiser is looking for is validation that other people are willing to buy similar homes in a similar neighborhood for a similar price. What we're really worried about is we're worried about the person that's buying the home that they grew up in, that was their family home, that they're willing to pay anything for because of the sentimental value of that home. And the problem is, if you can't succeed in home ownership and we have to take that home back, you are the only one willing to pay that price that is considered the sentimental value price of the home, because it doesn't mean that much to everybody else. And so we have to make sure you aren't the only one crazy enough to spend that price on the home. So that's the property piece. Cash, credit, and income play off of each other. And so if you are weak in any one of those three areas, traditionally, we can make up for it with the other two areas. Now, traditionally isn't really a word anymore that I can use because our rules are changing quickly. And so what was true a month ago isn't necessarily true today. But in general, if you're strong in two of the three areas, we can find a way to get you home. Even if it might mean the rules today don't allow for it, we can set a game plan to have you ready to qualify within 3 months, 6 months, 9, 12 months. So we're really focused on helping to look at really deeply cash, credit, and income and create a game plan for you going forward. So across the top, you're going to see some types of loans. You're going to see conventional. So conventional really is made up of two entities, Fannie Mae and Freddie Mac. You guys may have heard of them, you may not have heard of them, but Fannie Mae and Freddie Mac are two semi-government entities, two semi-government owned companies. Their role is to set the rules that say, hey, this buyer is qualified. If all of these things are true, then this is a sound mortgage that meets the guidelines. The difference between Fannie Mae and Freddie Mac is next to nothing. I kind of refer to them as the Coke and Pepsi of the mortgage world. Y'all have been there. You're a Coke person or you're a Pepsi person, and you end up going to a restaurant, not anymore, because right now the restaurants are closed. But in general, you go to a restaurant and you find that, hey, they say, what do you want to drink? I'd like a Coke. I'm sorry, sir, we only have Pepsi. No big deal. Like, you prefer Coke, but the truth is they're both kind of about the same. And so Coke or Pepsi doesn't really matter. They're basically the same, a little bit different recipe. The same holds true between Fannie Mae and Freddie Mac. They're basically the same, but a little bit different recipe. And so I just want to make it clear that it doesn't matter to you whether we're doing Fannie Mae or Freddie Mac. It's considered a conventional loan and the rates are the same. Conventional loans, your sweet spot is between 5 and 20% down. The truth is, conventional loans we can do with as little as 3% down. But it's a much more sensitive interest rate environment. Your rates go up significantly on conventional loans based upon your credit score and your down payments. And so I like to say conventional loans are highly sensitive, and that's why it says on there you have to have excellent credit to get a conventional loan. And the percentage of your income that we would let you spend on your house payment, your credit cards, your car payments, those are more strict on conventional loans than they are on government loans, FHA, VA, and USDA. So I'm going to switch to that category now. So the second category is what you see there is down payment assistance, FHA, VA, and USDA. Now I crossed off down payment assistance because unfortunately those programs don't exist right now. The banks have all but shut them down because of the risk involved with somebody buying a home in today's fragile economic environment without putting any of their own money for a down payment. The good news though is VA still offers zero down. So if you're a veteran of the US military, thank you for your service. As a reward for that service, you have the opportunity to put no money down, or at least no down payment. I'll explain in a minute about closing costs, because that's something you need to understand when you're talking about cash to buy a home. USDA, now you're saying, John, USDA, that's the Department of Agriculture. What does that have to do with mortgages? Well, what it has to do with mortgages is USDA was called upon by the government because there were farms in middle America that could not get access to money to buy homes for their employees or for themselves. And it created a problem with the agricultural economy because you couldn't get mortgages. And so they created a mortgage program, but it's only eligible in rural areas. Ooh, I said rural correctly. Rural. Say it 3 times fast. Rural. No, in rural areas. And so it's not gonna be in your highly populated areas in the Central Valley, Sacramento area. It's gonna be up into the foothills, further away. Actually, the one anomaly is Galt. Galt is considered a rural area because they're using the actual census data from 2000. And so we'll see what happens next year, even though they're doing the census right now, it takes about a year for it to process. We'll see what happens next year on whether they change the boundaries, but they ignored the 2010 census. And so Galt is still considered rural. You can do zero down payment using USDA and Galt. FHA, which stands for the Federal Housing Administration, has as little as 3.5% down. I also like to say FHA stands for Family Help Appreciated, because FHA, a lot of my buyers get their down payment assistance from the bank of mom and dad. So it's a great place to get money for a down payment, is getting it from family via a gift. Okay, FHA is much more forgiving when it comes to credit. FHA doesn't require as high of a credit score. Those credit score minimums are moving up right now. So typically to put 3.5% down, you needed a 580 credit score or better. Right now, most banks are closer to 660 to 680. The good news is my company has raised our minimum only to 620. Now that could change tomorrow, I don't know. But right now, just be aware that if your credit score isn't where we need it to be, you still should call me and go through the credit, because the score you get from Credit Karma is not the score that I use. The score you get on your Discover card statement is not the score that I use. We use a mortgage filtered credit score. So none of the scores that you get anywhere else is the same score as I get. And I pull all 3 credit agencies and we use the middle of the 3 scores. If there's multiple people on the loan, I use the worst of the 2 people, or the worst of all the people on the loan. So each person's middle score, the worst of all of the people. And so sometimes we replace somebody and say, hey, if we've got a husband and wife and one of them has really bad credit, we kick them off the loan and we get mom and dad to co-sign to make up for the income of the person we kicked off the loan. So there's some creative ways to make this work, and that's where I'm the expert. And so don't, just like you shouldn't operate on yourself or diagnose your own medical conditions, although we all try and do it on WebMD, the fact is it really isn't a good idea. And so what I can do for you is run my credit simulator. My credit simulator allows me to pull your credit and then play with the numbers and say, hey, what if we do this? What if we pay off these 2 credit cards and pay off this collection and open a new credit card and then wait 6 months? What's the score going to be? And it's a very accurate forecaster. The only thing it can't predict is the future. And what I mean by that is other things can change. If you open up more accounts than what you said, or you don't pay off the balances, or you charge up other balances, or you're late on something, it can't predict those other anomalies. But if everything else stayed the same, that forecaster, I live by it. And I have had many clients who don't have good credit, We give them a game plan using my forecaster, and within the time frame the forecaster is allocated, they follow the rules and they qualify and purchase a home. So don't let credit concerns stop you and say, oh my gosh, John said I have to have a 620 credit score. That is only a temporary hurdle that we can overcome. The same thing if you say, oh my gosh, I don't have enough money for a down payment, or I've been told I need to save 20% for a down payment. I'll show you in a couple of minutes why that fallacy of needing to save 20% for a down payment is in fact not the right approach. But I'll cover that in a couple of minutes. So the other option here, the last column, is jumbo loans. Guys, jumbo loans depend on the county. Jumbo, by definition, is big, and so it's big mortgages. Depending upon what county you're in, nationally, jumbo loans start over $510,000 in loan amount. Now, if you bought a $550,000 home and put 10% down, you're borrowing $500,000. That means it's not a jumbo loan. So that's an example of the cutoff. In other counties in the Bay Area, it's up in the $700,000 range. In the Sacramento market, it's in the mid to high $500,000 range. So each market has a little bit of flexibility. The problem is in every market, as soon as you get over 510,000, the rates start going up. The jumbo product is almost extinct. A lot of reasons why, and I won't get into it on this call, but the bottom line is, as of 2 weeks ago, I had 11 different banks that I could lend their money directly from me. Means I wasn't the broker. I was underwriting the loan, I was approving it, and I was funding it, and then we would sell the loan to that bank. Over the last 3 weeks, 10 of those 11 banks have stopped doing jumbo loans. We have one left, and the rules are really, really tight. And so hard to qualify for jumbo loans right now. Rates are high. It's a really high risk, and this market dynamic we're dealing with is causing jumbo loans to be out of favor. Okay, so that's a pretty good explanation, if I do say so myself, pretty good explanation on types of loans. But what I want to do is go one step further and talk about funds to close. So when you need money to buy a house, you have to remember that there's more than just the down payment. You also have the closing costs. So your down payment, you need 0% down or nothing for VA and USDA, as little as 3% down for conventional, and as little as 3.5% down for FHA. That money can come from your money. You can get it from retirement accounts too. And the CARES Act that was passed a couple of weeks ago lets you dip into your retirement account without penalty. So that's another great opportunity, and why it makes right now a really good time to buy a home, because you can tap into your retirement funds without penalty. The other thing you can do is you can get it from gift funds. I talked about the Bank of Mom and Dad, and you can also get money from down payment assistance programs if and when they come back. The other piece you have to pay for is closing costs. I'll say the average of closing costs is about $10,000. It's a really good figure for you to estimate. Okay. Speaking of estimating, I forgot to put this in my presentation, but I want you guys to all download my mobile app, and it's really easy to get my mobile app. You just go to app.johnloanking.com. So if you go to app.johnloanking.com and you, on your mobile phone, so it's app.johnloanking.com. Download my mobile app. It's got a great calculator in there that will allow you to calculate your monthly payments on different scenarios. But just remember, when you're calculating your down payment, the app shows you the down payment. It doesn't show you the closing costs. You need to budget $10,000 more for closing costs. That pays my company's $1,525. You got $500 you pay the appraiser. You got about $2,000 you pay to the title company for title and escrow services. And then you've got, typically you pay about 1% of the loan amount in what's called a point. And that depends on the market and what rates are that day as to whether you want to pay the point or not. Points give you a lower interest rate, and I'll cover interest rates in a couple minutes. The other thing that you pay for is what's called prepaid expenses. You're prepaying the first year's homeowner's insurance. You're putting money aside to pay towards your future property taxes and your future homeowner's insurance. all of that money has to get put into the loan, and that all is built into the approximately $10,000 I'm budgeting. Michael, thank you so much for asking a question. Now I know somebody's listening. You said, do I know how long you have to pull out your 401k without penalty per the CARES Act? So I'm not a tax advisor. I don't pretend to play one on TV. What I will tell you, though, is it's my understanding you don't have a penalty at all. You can actually pay the money back, and I believe it's a 2-year time frame, that if you pay the money back within 2 years, you do not have to pay income taxes on the money. That part I'm a little fuzzy on because I just heard somebody talking about it, and I haven't researched it myself, but what I do understand is the 10% penalty that you would pay for pulling money out of your 401k is waived right now. So that's a huge savings, and potentially if you put the money back in, then you don't have to pay income taxes on it either. Again, that part I'm a little unsure of. So hopefully that helps answer your question, Michael. So guys, here's the deal. With closing costs, you have 2 more places that you can get closing costs from. You can get them from the same 3 above, your own money, gift funds, or down payment assistance, if those ever come back. But you can also get them from a seller credit and a lender credit. Now, why would a seller or a lender pay some of your closing costs? Well, from the lender's perspective, we would pay it if you paid us a higher interest rate over the life of the loan. The problem is, in today's market, lenders are not giving you upfront credits for a higher rate because of the market volatility. We're really, really worried right now about rates going down. Now you'd say, John, why do you care if rates go down? We care if rates go down as an industry because we count on earning interest over a certain period of time. And if rates drop significantly, you might refinance in 6 months. Cool, good for you. And overall, we're all happy to do that. But we're not going to write a big check to pay your closing costs in exchange for charging you a higher interest rate, because charging you a higher interest rate actually just makes it even more likely that you're going to refinance sometime soon. And so for that reason, mortgage banks are simply not giving large credits for increasing your interest rate. And so getting a lender credit in today's market is highly unlikely. Now, getting a seller credit in today's market, especially right now, like right now during the shutdown, it's a great opportunity to get a seller credit. Why? Because the sellers who are selling today need to sell their home. Because most sellers aren't going to want people tramping through their house and looking at the home or having to deal with moving during the time that we have a shutdown like this. And so the sellers that are selling today are highly motivated, and you don't have a lot of competition of buyers that are competing to buy that home. And so you can go in and say, hey, I'll give you full price, but I want you to give me $10,000 back for closing costs. That's a strategy that I'm finding is working more and more in today's market. Now, once the quarantine's over and everybody's been released and the demand is there that people want to buy houses, your chances of getting an offer accepted with a seller credit just went way down. So now is the best time to buy a home if you need a seller credit. Here's the other thing to think about when you're writing offers and you're asking for a seller credit. Sellers are human beings, and human beings are emotional. So think about if you were selling your house and somebody came to you and said, hey, we're going to use that example of that lady that thinks her house is worth $375 because she painted all these walls pretty colors. And you know the house is only worth $350. So you're going to go in and say, hey, ma'am, I'm only willing to give you $350,000 for your house. And on top of that, I'd like you to give me $10,000 for closing costs. How dare you, she's going to say. How dare you insult me and then pour salt in the wounds. I know I mixed my metaphors there. But add insult to injury, or pour salt, cut me and then salt in the wound. Y'all get where I'm coming from. Anyway, how dare you do that? They actually would have responded better if you simply would have asked to buy their house for $340. Because at least you were only asking for a lower price. But how dare they ask for a lower price and ask me to pay for closing costs? I say that because when you're in a situation where the asking price of the home is pretty reasonable, I strongly encourage you to only ask for closing costs. Don't try and also get a reduction in the purchase price, as long as their asking price is reasonable, because you're going to pull out the emotions of the seller if you're asking for both a credit for closing costs and a decrease in sales price, not because the total dollars, but because you're asking for this and this, and you want to make sure that you get your offer accepted. And so that's really where I'm coming from in this conversation. All right, so top 30 factors that determine an accurate rate quote. Okay, so y'all got to read all 30 of these. I'm going to read them to you now. Ready? Number one, totally kidding. I would not read these to you. Here's the deal. Interest rates change every single day, but that's kind of the starting rates. The starting rate changes based upon all of these factors, kind of like gas prices. So you got what the price of a barrel of oil trades for, and that pretty much drives what the price of the gas you pay at the pump is. But maybe you go to Chevron, and Chevron has Techron. And so Chevron charges 10 cents more per gallon because they added Techron to their gas. I don't know if it's any better, but anyway, so you pay extra for that. Maybe you buy diesel instead of regular gas, or maybe your premium instead of regular. And sometimes there's only 10 cents between premium and regular, and sometimes there's 25 cents. That's all the same concept of what we're dealing with here. We've got all these different factors that go into determining what your rate is. And so when you call me up and you say, John, what's today's rate? There is no such thing. I have to know all this stuff about you. I have to look at your credit. I have to know your down payment. I have to know what type of loan that you're doing. So many factors that we look at that come into play, and you need to have this information. So when somebody says, here's today's rate, they're lying to you. There is no such thing. But the most important thing to understand is you lock your interest rate once you get your offer accepted. We're locking the rate for you to buy that home. And so if the seller of that home later on says, hey, I'm not willing to play ball, you want some repairs, and I'm not gonna credit you for those repairs, and you don't buy that home anymore, no problem, but you lost your rate lock because we locked you to buy that home within a finite time frame, typically 30 days. But the nice thing is once you're in contract and we freeze your rate, you never, ever, never, never, ever, never have to worry about your interest rate changing. The only types of mortgages that I'll do for you are 30-year, or you can do shorter terms, but they're fixed rate mortgages. The only thing that will change in your monthly payment is the property taxes and the homeowner's insurance, because we don't control that. In the state of California, Prop 13 manages property taxes, and I don't have the time to get into that today, but your property taxes go up by 2% per year, and that's it. But that means your property tax payment will go up. And your insurance company, just like your car insurance, every year they give you a new policy and it's a little cheaper, it's a little more expensive. Most of the time it's more expensive. That's also going to impact your mortgage payment. So just be aware of that. But the rate would be a fixed rate and you're not going to have to worry about your mortgage payment changing. Guys, I want to take the last 10 minutes that we've got. Feel free to ask questions, but I want to talk a little bit about accumulating wealth. Because I think that my number one role in people's lives is to get them into the biggest debt they've ever gotten into in their life. And I want to take an opportunity to help you get out of debt, help you build wealth. And homeownership is a key step to that. But overall, I want to educate you a little bit on 4 strategies that I use and I've been taught to help build wealth. And I like to teach it to as many people as I can. And so I'm going to talk about each one of these 4 strategies over the next couple of minutes. Feel free to put any questions into the chat, and I'll make sure to leave a little time at the end. So the first thing is buying a primary home is the first step to building wealth. And you really want to follow these things in order. Now, no, I'm not just saying that because it's my job to help you buy a primary home, but it makes a huge difference in your wealth, and I'll explain it right now. So my first example is going to be a conventional loan. You buy a $350,000 home, and that $350,000 home, here we go, that's what I'm looking for. All right, so right here, you can see now I got a little red dot floating around. Woohoo! All right, so you buy a $350,000 home. Your down payment is $35,000, 10% of the purchase price. So that's your investment. That's how much money you've spent. Good real estate goes up typically 3% a year nationally. On the coasts in California, it's more like 5 or 6% a year. Now that isn't every year. Some years are lower, some years are significantly higher. But for my example, I'm only going to use a really conservative 2% number for how much the real estate's going to go up. But the cool thing is 2% per year over 5 years equals a 10% increase in the value of the home. That means 10% of $350,000 equals $35,000. So you have earned $35,000 because the market grew by 10% over that 5-year time frame. But you only invested $35,000. So the truth is your return on investment over that 5 years was 100%. You doubled your money in 5 years. If you divide that by 5 to get the annual return on investment, you're making 20% per year. Guys, there's nowhere that you can put $35,000 or any dollars and make 20% per year return on investment on average. That's what makes owning primary real estate the best place to start in building wealth. The second example is an FHA loan because you put less money down. So with an FHA loan, you're only putting $12,250 down for the exact same home. So that means that if we have the same 2% per year appreciation, that same $350,000 home grew by the same $35,000, but you only put $12,250 into it. That made your return on investment almost 3 times what you put in, which is around 57% per year. So when people say, John, I don't want to buy a house yet because I want to save up 20% for a down payment because I don't want to pay that mortgage insurance. Mortgage insurance is a fee you pay when you're putting less than 20% down on a home. What I tell you is mortgage insurance is a really, really small cost for the benefit of this huge return on investment. And if you did have 35 grand to put down, but instead you kept it in the bank and only put the 12,250, you still earned your $35,000 appreciation, and the other $27,750 you can invest in the stock market or somewhere else and earn money there. So it's about leverage, and the house price will go up or down, but I mean overall it'll go up based on the price of the home, not based on how much money you put down. I want to talk a little bit about the financial benefits of owning a home. 3 basic things that I talk about. First is a tax write-off. You're going to save, and again, this is a ballpark number depending upon how you itemize your taxes. So the tax write-off may or may not apply to you, but you need to talk to your tax advisor. You see that right here. But you could save $590 a month on the high end for your tax write-off, depending upon what your current deductions are. Forced savings, guys, most people pay no attention to this fact. On a $350,000 home, you have $300 a month of your payment that is going into paying down the balance. It's a forced savings account. So if you're thinking about buying a home and you're saying, you know what, I don't know if I can afford that monthly payment. That's a couple $100 more than what I budgeted for. Maybe you cut back your investments into your 401k for a short period of time, because maybe you have $200 a month going into your 401k. But if you buy a home, you get $300 a month going into forced savings by paying down the principal on the home. You're just trading money from one investment pocket to another. But remember, the key on a home is it appreciates based on the entire purchase price. And so just if you had to lower your 401k for a short period of time, it makes it worth it. And then you have the same scenario we talked about with appreciation, where you have that $7,000 a year that the house is appreciating, which is $583 a month. Guys, that's almost $1,500 of savings that you get between your tax deduction, your principal pay down, and your equity appreciation. So huge, huge financial benefits for owning a home. Step 2 of building wealth is reserves. Before you start investing money, you need to make sure you have 3 to 6 months of savings in an emergency fund. That's hugely important. I know sometimes we have to dip into that when we're buying a home, but that's why buying a home is step 1. But as soon as you can, you need to rebuild that 3 to 6 month emergency fund. And the truth is we're living through times right now that make that super, super important. Step 3, max out your 401k or your IRA. And you should typically split it up into 3 mutual funds. Again, I'm giving you high-level overview, high-level information. Talk to your tax advisor, talk to your financial planner, but I'm just giving you kind of some big picture ideas. Step 4 is when you start investing in the stock market. And Warren Buffett created this plan, so I'm not taking credit for it, but Warren Buffett made some pretty good money. So I'd say a plan that he's got's a pretty good plan. And it's really, really simple. Whatever money you can invest in the stock market, only do it when you finish the first 3 steps. But whatever money you can invest in the stock market, you put it in every month and you split it up 6 ways. You split it up into 5 stocks that you believe in and that you buy. And so if you believe in Apple products, then you should buy Apple. If you shop at Costco, then you should buy Costco. If you love your Nike shoes, you should buy Nike. 5 companies that you believe in and you shop at or you patronize all the time. Because if you go to Disneyland all the time, again, maybe not right now, but if you go to Disneyland all the time, then you see the value in it, and therefore many other people see the value in it. Invest in things you know. That's what you do with 5 parts of the money. The 6th part, you invest in the S&P 500 because that gives you a piece of the entire market. Most investors are comparing themselves to the S&P 500 and say, hey, I beat it, or hey, we just almost beat it. Well, why in the world would you not then own the thing that everybody is using as the benchmark? So buy 5 stocks of things that you believe in and put one more, so divide it by 6, 5 stocks you believe in, and invest in the S&P 500. All right, guys, that's it. We've got about 5 minutes left. I really appreciate your guys' time. I appreciate the question that I got, so at least I know that you guys are listening. Thank you, Joanna. I appreciate it. Guys, if you have any other questions, I'll hang out here for another quick minute. But I really just look forward to the opportunity to help guide you through the process. Don't forget to download my mobile app. So it's app.johnloneking.com. You see my website right here, johnloneking.com. If you just add app at the beginning of it, it'll take you on the App Store to the Summit Funding Home Now app. It's got a great calculator in it. And it will help to walk you through the process. You can start the loan process right there by clicking start the application, and it sends it securely and directly to me. Aside from that, gang, I really appreciate your time. It looks like we don't have any other questions. Feel free to post in the chat room how amazing I am. I like that too. Really appreciate everybody listening today. I'll be posting this on YouTube and on Facebook, so if you want to see it again or share it with your friends, please do so. Have an absolutely amazing night, and we'll look forward to talking to you all soon. Bye-bye.